Good
Zoom,
afternoon.
is there a way to get the videos?
We're on live now, gentlemen. No, if you have any questions, just let me know. Anyway, good afternoon. My name is Bruce Bolger. I am founder of the Enterprise Engagement Alliance and host of today's EEA Zoom show, which we're grateful for many of you who are attending live. But we will also be available if you wish to share on our YouTube channel on human capital management and enterprise engagement. And we're very lucky to have people from the front lines of this emerging area of human capital. And we're specifically going to be talking about the role of the CFO. And so I'm going to start from the upper left. We have Kimberly Lanier. She's Associate Director of Organizational Transformation at Protiviti, which is a leading human capital management company worldwide. Dave Bookbinder, who's an innovator from the financial side on human capital, especially as it relates to acquisitions and mergers and acquisitions, I should say. And he's written a book, The New ROI, Return on Individuals. Then we have Glen Hartenbaum. He is a CFO for Gemini Bakery I hope I, oops, got that wrong, I think, because I can't see your information there, Jim. Sorry about this, folks. Kind of messing this one up. Yes, Gemini Bakery Corporation. And he's really at the front lines of these issues, and he's been gracious enough to join us. And then Jim Caruso, he is a CFO for Simplura, which is a healthcare company, and each one of them will be telling us a little bit more about what their companies do. So I'm going to stop the share now, and we're going to get right to the conversation. And Dave, I'm going to start with you. You've been a real leader in this concept of human capital management and the ROI of individuals. To what extent do you think, what is the maturity state in financial circles of really focusing on human capital management as an intangible rather than as an expense?
Well, as an intangible asset, Bruce, as your audience may be aware if they've ever done an acquisition, the value of human capital right now winds up being subsumed into goodwill. So in the course of what we do in valuing intangible assets in the course of purchase accounting exercise, most of the value winds up going to the assets that you would expect, typically trademark and trade name, other intellectual property assets like technology, and of course, customer relationships, things like that. I personally believe that the company's most valuable asset happens to be its people. And I know we're going to get into that in a little bit, but I guess to answer your question more directly, I think we're in the nascent stages of seeing this evolution. And I know you're going to talk about some recent news that I think will help to move the needle on this.
Well, so Kimberly, you have been in the human capital space for probably 20 years, based on my knowledge of your background. How much do you think, again, where would you put the life cycle? Where would you put the whole focus on human capital management as a strategic CEO focus and a CFO focus on its life cycle from your experience over these couple of decades?
Yeah, it's really interesting to watch some of the market trends emerge where there's increasing focus on the value of human capital. It's coming from multiple places. I know we're going to be talking about some exciting developments that are more regulatory in nature, and that's a component of it. But I think human capital, the field, the study, the discipline, is getting more C-suite attention than ever before. And there are a lot of dynamics that are pushing that. And it ranges from things like an increased focus on customer experience. Well, who develops and delivers that customer experience? It's your employees. And that elevates the criticality of having them engaged so that they'll treat their customers as well or better than they themselves are treated. So you're seeing it from that angle. You're seeing it more from the quantitative angle, from a CFO perspective, and understanding, as Dave mentioned, the inherent connection to a company's valuation and market value. So I think we're going to see continued trends and emphasis because a lot of these market forces are advancing this kind of simultaneously.
Well, thank you. And the reason we wanted to have Jim Caruso and Glen Hartenbaum here is that There's some big macro trends, but at the end of the day, business happens at the front lines. And the big macro trend that I think we can introduce here is that the Securities and Exchange Commission on August 26th, for the first time, said that companies, it's issued a new regulation that all companies, publicly held companies, must report on their human capital resources, practices, to the extent metrics, to the extent that they are material to their operation, specifically their methods of recruiting, retaining, and developing their people. And those are pretty much the words of the regulation. Incredibly open-ended. And obviously, Jim and Glenn, you folks are not don't work for public companies. But the interesting thing that the new regulation says is that human capital is material to an organization's success. Material is a fiduciary word. It basically says if something's material, then you have to address it. So, Jim, I'm going to start with you, but Glenn, it's going to be the same questions. You're CFOs that do care about people. I know that. To what extent do you see this human capital, this new focus on really looking at intangibles as an asset and measuring them properly, coming into a fore? And do you think that will be adding to your plate of activities?
Yeah, and I welcome it adding to my plate. As you say, I do care about people. I care about people all feeling a sense of purpose. Building, we're a home care company, so we care about what we call the caregiver experience. For them to have a positive experience means that our clients that they take care of in the homes will have a positive experience. And I look forward to being able to quantify these things. I think we all know they're important, and but we think about them qualitatively as opposed to quantitatively. So I definitely see this as a trend, even in other organizations that I'm part of professionally as a CFO. There's more and more of an engagement with the HR side, bringing together CFOs and CHROs and exploring these types of issues and really looking at the whole return on experience. So, I think the trend is unstoppable. And, as you say, now that it's a public company reporting requirement, those public company requirements tend to ultimately make their way to private companies. So, especially those that are private equity backed and professionally managed in a very similar way. So I think that, the future is definitely upon us here.
Glenn, your perspective.
I think Jim stole a lot of my thunder, and I couldn't really agree with him more. I hope this gets added to my plate, and I think it will, regardless, just by the fact that the SEC has passed it. As Jim said, a lot of the stuff from the public world does filter down to private companies, if not to the letter of the law, just in terms of a push. And, in every organization, I've looked at a number of different ones, but in manufacturing as well, it's important to be able to, it's hard to find sometimes skilled labor, whether it be welders or people that can fabricate our equipment, and being able to make sure that we have an environment for them that's, positive. They see a path forward. They like coming to work every day, whether it's our technicians that are out installing it, interacting with our customers. So I think that it's critical. And I think the real challenge, and I think that being able to follow this trend in terms of what the SEC has done and going forward is, some of the metrics that we think about are easier for us to get, things like retention. But I think that where you really want to work is in measures of things like employee engagement. There's other areas where you may not have a hard and fast measurement in the way a CFO might think of it, but there are ways to measure it. And that's really what's going to be critical.
And so Glenn and Jim, just quick questions on this. So where do you put this whole focus on human capital on the maturity scale on a 1 to 10? 10 being mature. Jim?
Well, I think I would say it's low on the scale. It's probably, around a 3. And I don't mean that in terms of its level of importance. I just mean in terms of the level of sophistication of having quantifiable measures beyond traditional items, around, as Glenn said, retention or turnover or things of that nature, even some employee satisfaction metrics and things like that. But, that's all old school right now. We're talking about being able to bring more qualitative metrics to other aspects. And I think that is in its infancy, really.
I would
And
agree.
Glen,
I was going to
so
say, I would
around
probably rate
2 or
it.
3.
I was going to say it too.
Yeah.
Maybe a 3 at best. I think that there's a lot of work to do. I think that most people, I'd like to think, understand the importance of it, but in terms of really putting this to the fore in terms of the way that we as CFOs and I think our senior managers look at other more traditional financial and operational metrics, it's got a ways to go.
So Dave, you are very much involved. Full disclosure, Dave is our curriculum advisor at the Enterprise Engagement Alliance for our learning platform related to finance and measures. And Dave, as you're aware, there are very clear metrics today that are available that have come out of ISO 30414 human capital management, and very metrics such as human capital ROI, that's the return on investment you get from the money that you spend on people. And how do you measure that? It's actually a pretty simple calculation that tells you for all the money you pay for people, to what extent do they contribute to your bottom line? And then there's a human capital value add that gets that down to the individual level. That's also a pretty basic calculation. And then there are other basic calculations like revenues per customer, cost per customer, profit per customer, and willingness of customer to recommend. It could be what's called an NPS score or other types of engagement scores. And then you might have, David, also, as all of you might know, the same thing for employees: revenue per employee, cost per employee, profit per employee, turnover, willingness to recommend. Dave, in your view, how many companies do you think are running using scorecards like that to drive their businesses? And then Kimberly, I'm going to hit you with that question also.
I don't think there are very many, to be honest with you, at least certainly not from my experience. And I think part of the reason why is because while everybody pounds the table that people are a company's most valuable asset, unfortunately, I think what follows that is oftentimes the notion that people are our largest expense. How do we reduce them? So with the thought that people are an expense, not an asset, it's a different lens, it's a different modus operandi in how you treat people. And in my world and valuation consulting, I always say that until people wind up back on a financial statement, I don't think it's going to matter quite as much. But the good news is, with regard to this SEC statement, I'm really excited about that, because I do think that's an opportunity for continued growth in this movement. As Jim said, for privately held companies, a lot of what they experience in their reporting requirements are driven by their public company counterparts, especially in the PE space. So if there's a focus of attention on public companies to do significant disclosures around human capital, one, that may lead to people back on a financial statement, which would be great, because I think that changes behaviors at a fundamental level. But from my lens as a valuation professional and kind of the thrust of the book about correlating the value that people contribute to an enterprise value with these disclosures, if there's enough of them, we can perhaps really do some meaningful correlation analysis to determine the direct relationship between the proper investment in human capital and a company's market cap. And that could be groundbreaking stuff.
Oh, and that's when you really get people's attention. Kimberly, you've been at the front lines of implementation for years in your previous jobs. You've been involved with budgets, enormous budgets that automotive companies, packaged goods, insurance, financial services, to motivate people, to engage them. And in all honesty, how many companies really carefully measured those programs against their organizational objectives, against the specific goals they wanted them to achieve, and then maybe even track 6 months later to see whether there was a residual benefit? How much science have you seen of ROI over the years you've spent in this space?
Yeah, unfortunately, it's pretty rare. A lot of organizations tend to look at a lot of programs like that, whether they're rewards or recognition or incentives, as kind of a checkbox to check off. It feels like something that is the right thing to do for employees, but most of them fall short in terms of strategic design, implementation, and rigorous measurement. There are a couple, but they're very few and far between. But those that are disciplined about it tend to get that ROI that they're looking for. I'd point to one that I worked with over a number of years, which was Delta Airlines, that really had a very rigorous discipline around quantifying the value, and they had goals to become, win the J.D. Powers Award and so forth. And they accomplished those through targeted investments. But for the most part, a lot of those big budgets are distributed, on a kind of an ad hoc discretionary basis, and that makes it harder to be able to track that investment over time. So a lot more discipline is needed in that area.
So Jim and Glenn, getting back to you, and Glenn, I'll start with you this time. If an HR person, I believe we spoke that HR does report up to you at least on a dotted line basis.
On a straight line basis.
A straight line basis. So, and you've been in finance, CFO for quite a while. Is it customary, and don't be embarrassed if the answer is no, because you would be an outlier if the answer to this is yes. How often did HR come to you with initiatives where they said, this is what our organizational objective is, this is what we're trying to achieve in terms of turnover, productivity, quality, or achieving our organizational goals. Here's a recommendation on how we can do that. Is that traditionally part of the HR culture that you've encountered over the years? People that really made a business case?
No, I think you have touched on that. The answer is no. And I think it's not because they're not thinking along that way. It's just the lack of rigor. And hey, I'm in the boat too. HR reports up to me, but it's really just a question, as we're talking about, I guess, in this whole meeting, is to try to make sure that we have tools and metrics so it makes it easier for when the HR people want to come to give that to me, we're all talking the same language. But as of right now, no, there's not rigor. There's thoughts and, I guess, qualitative discussions as to, hey, this really does fit with our culture and our values. We think this will push us forward, but that's as far as it goes. And
Jim, your perspective on that. You have a fair amount of employees, Jim. Don't you have something like, how many employees do you have?
Well, we actually have over 10,000.
Yeah, that's a big company. So keeping alignment, and a lot of these people work out of the home even before COVID, they're mobile workers, right? So having engagement and alignment and focus on your values could not be an easy thing.
No, as Glenn has HR reporting directly to him, for me, it's more a dotted line basis. We're fairly decentralized in terms of operating in 7 states and having regional business unit leaders and HR within each of those units. But then there's some, obviously some enterprise-wide coordination and a framework there. So the HR professionals would dotted line to their business unit leaders and also to me. And like Glenn said, there are a lot of things that they want to do, not just HR, but the business unit leaders, and they're great ideas. And, a lot of CFOs, their first answer is no, because it costs money, right? But I'm not like that. I mean, I do understand the importance of these initiatives, but I understand it intuitively. And I think what we're talking about here is the difficulty in quantifying that. And it would be my responsibility to gain organizational support for these initiatives with the CEO. And, our CEO is very numbers driven also. He's a financial professional by trade. So, to be able to have a common language and really, speak to the numbers, because that's how we would do anything else, right? Any other large investment would be, is there a return on this? And, whether it's IT or real estate, whatever, right? That's what you have to look at. So, I think the importance here is having quantifiable metrics. And, I don't think it's that, that other employers don't care about people. I think they could care very much, but they just don't know how to put a measurement on it. And they feel like, okay, well, that's the intangible. I treat people great. We have a great culture, but then the financial is over here. And, we need a way to connect the two and look at everything in a common way.
Well, and Dave, this is, as the 5 metrics. I think that globally, the research would show that the metrics that most companies need to track are, again, that human capital ROI, human capital value add, because those two numbers have been shown to relate to EBITDA. They relate that if you are improving your human capital ROI and your human capital value add, you will see a corresponding improvement in your EBITDA. There's a bunch of research, and Dave, you've worked with companies along those lines. And I think the other metrics that a lot of companies have to look at, besides the human capital ROI and value add and the productivity of your customer and employee relationships, right? You also have to look at, you have to look today at diversity and equity. And diversity today is an opportunity. It's not just a moral obligation. It's a business opportunity because, and this is leading to a question, Dave, diversity, you have more customers to choose from. You have more supply chain partners to choose from. You have more talent to choose from. And people tend to recruit their communities into your company. So and then I'm a New Yorker, it's just more fun, but besides that. So, and then you have training and development effectiveness, not just training and development, but how effective is it? So Dave, you're in the acquisition space and you're helping companies with valuation. Having metrics like these, wouldn't that make it easier and more to be able to really put a value or at least to identify risk? Because if anything else, this whole concept is risk mitigation. Because if you have better relationships with people, there are less risk. So is all of this, do you think, valuable in the human capital value in terms of mergers and acquisition?
Oh, yeah, no question. And you hit it on the head with EBITDA, because anybody who's involved in an acquisition, generally speaking, what you hear is a multiple of EBITDA. So to the extent that you can increase EBITDA for every dollar, you're going to get a multiple of that. So pick a number, call it 10x, right? So every dollar is worth 10. So it's certainly in a company's best interest to do whatever they can to increase EBITDA. One way to do it traditionally has been to reduce expenses. What we're talking about here is to really maximize the valuation of an enterprise by tapping into this intangible asset. And I would add just one other piece in terms of the valuation component, Bruce, and that's with regard to a cost of capital. The studies that you alluded to demonstrate that companies that are doing these right things, like the Just Capital folks talk about, enjoy a lower cost of capital. Valuation is a forward-looking exercise, and the value of the business is a function of the present value of future cash flows. Present value being that cost of capital. So the lower the cost of capital, the greater the valuation. So there it is. It's all connected. It's the people.
Well, and then Dave, you also look at forward. The whole idea of an acquisition is you're looking 5 years ahead. And aside from the risks of culture mismatches, which we've seen in headlines recently of companies that bought another company that had a huge legal suits right underneath, that were not detected, and a big culture misfit, you have, apparently there's a big relationship between forward performance and human capital ROI that I would imagine 80 to 90% of acquisitions are overlooking these key metrics. What's your view on that?
Yeah, I mean, statistics certainly bear it out. Depending on where you get your numbers, anywhere between 75 and 90% of M&A deals don't give the synergies that the participants expected. And the number one reason cited for that was poor cultural fit, cultural integration. Again, it gets back to this mindset that people are fungible, and the valuation methods that we're using right now certainly don't do anything to change that perspective. But when folks don't mesh from a cultural perspective, institutional knowledge walks out the door. And I call it the intangible within the intangible. And it's really the nuanced stuff, Bruce. It could be something as simple as if somebody's been in an organization for 10 years, for example, and they know what their boss's proclivities are. How does this individual like to receive information? Where do you go to get a certain product or supply? Who gets stuff done? Just that simple sort of innate knowledge that somebody accumulates over the years literally walks out the door. And despite maybe best efforts to do a mind dump before employees leave, you can't capture all that stuff. And I know Glen, by the way, was a contributor in book 1, New ROI, as a contributing CFO. Bruce will be a contributor in book number 2. And I think these guys may be able to lend some insight on what their experience has been from M&A perspective in that regard.
I love Dave's comment of the intangible within the intangible, because I think that's really important to note. And I just want to tag on to what he said in your question, Bruce, that some of these financial metrics are incredibly important, but there's also a broader view of outside of the pure acquisition environment, whether you're trying to build valuation or just simply operate better as a company. We're encouraging clients to have a broader scorecard that includes the financial dimension as kind of a lagging indicator, but there's also a whole series of these leading indicator metrics that can help you with a broader view towards your human capital function as a whole, to manage it kind of end to end.
And Kimberly, just for those of you who don't know, EBITDA is earnings before income, tax, and amortization, I believe. It's a technical term. It means money that you make. Glenn and Jim, when you look at, there's some interesting implications when you really get into human capital analytics that drive decisions related to compensation. I wanted to share with you and get your inputs on. Because again, Dave said that most companies just look at reducing expenses because that's what they can measure. What they can't measure or haven't been able to measure is what are the costs of high turnover, really? What is the cost of losing talent? And, there can be an argument in many companies that you really want to have high turnover, because if you have high turnover, because if you have somebody stay for you for 40 years and they're getting 2% raise every year or something like that, all of a sudden their pay is double, right? And if you're not capturing that in productivity or quality or added value, that's hurting your organization's profitability. And yet, I'll give you gentlemen an interesting example of how those mechanics work. In the New York area, there's a company known as Stu Leonard's. Stu Leonard's has 5 grocery stores, like 6 maybe now. They are the most profitable grocery stores alleged to be in the world. Before COVID, you'd see busloads of business people coming from around the world to tour the stores. They're privately held, so we don't exactly know how much money they make, but it's a lot. And they are purported to have the highest square foot sales per grocer anywhere in the US. They pay double minimum wage to start from any other company. They've always paid double minimum wage. And by the way, this isn't a political thing. It's a family long associated. If you go into their stores, the owners are frequently seen with great presidential Republican presidents and whatnot. So it's not a political thing. This is pure business. Now they've done the math and they have determined that they actually do better by paying more. Now, Glenn and Jim, not putting you guys on the spot because these new metrics are so new, all right? And the very fact that you two are on this show, which is going to be on our YouTube channel for years to come, I hope viewed by many people over the months and years, because this is really useful information. Do you think that human capital metrics, in a way, when we really start to analyze it, might change the way we make decisions, because we might realize that we're missing wealth opportunities that we didn't see? Glenn, I'll let you take that.
Okay.
I'll stick you with that, Glenn, first.
Okay. Well, no, I think that there clearly is a missed opportunity there. And again, it keeps on going back to what I've said before. And then we had that situation where even in my current company, where we have about 110 employees, where we were struggling to get the right work done, and we decided we needed to pay more to get the quality that we needed. But in terms of figuring that out, it was somewhat just intuitive, or maybe you get hit in the head enough with employees that aren't doing what you need to do. You realize, well, let me find the right person. And then if it costs a little more to bring that person in, that's what we do. But I think really having this analytical framework would make that sort of decision process a lot easier.
Yeah, because at the end of the day, it isn't just even paying more. Stu Leonard's has a whole philosophy of developing them. By the way, training them so that they share jobs, for instance. So there's a whole cross-training opportunity. Or Trader Joe's is another example of a company. If you work at Trader Joe's, you change your job 5 times a day or a week. You're continually changing. You might be in bread, and then you might be in another area. And most companies would never do that. But you ask a Trader Joe employee and they say, that's why I like working here. My day spins right by. But then Trader Joe has greater job flexibility, higher retention, and therefore their productivity per employee. We can't just throw money at this, Glenn, right? And Jim, turning it over to you. No one is advocating that you just raise your pay, double the pay, and magic's going to happen. It does not work that way. It only works if it's part of a strategic plan measured against metrics so that you can go to the boss and say, yeah, we raised everybody's pay $10 an hour, but guess what? And I'm not saying you should do that, but guess what? Look at our bottom line. Look at our ROI of our human capital and look how our EBITDA has improved. Why? Because we've lost all these associated costs that we didn't know we had.
Yeah, and I think, what's harder for people to see is cost avoidance. You talked about turnover. You said some companies would actually prefer to have the turnover so that salaries don't grow too much. I mean, I would never want to see that, but I think that we all know there's a cost to turnover, but people don't know how to quantify it, and they can't really see it, right? Like, where do you really see that 6 months that it takes somebody to get up to speed? It's hard to track these things. So, especially in home care, right? There's a relationship between the client in the home, an elderly person and the caregiver. If the caregiver leaves and we lose the client because they really liked that caregiver and they don't like the new one, there's lost revenue there. Now, you can quantify that, but it's hard to track, right? To trace that back to the event. So, I think, it's one thing to, certainly look at ROI, and another, then there's this cost avoidance aspect that in some ways is even harder to really get on people's radar screens.
Well, legal suits, litigation actually can be measured and tracked, right? And every company has a budget for litigation. And litigation, when you do these things right, is one of the first things that you start to see go down. There's less friction. Kimberly, we have a very good point here. One of our attendees has made a point, and she says it's just a comment, but it's thank you, Darcy, for your point, because it leads right to what I want to talk about, Kim. She says that, we often view employees as an expense, not just payroll though, right? We do all of these different things, right? It might be employee engagement. We do an employee engagement survey, a training program, and yet they deliver little or no ROI. So she argues here that with the right metrics, companies should and redirect and even save dollars in investing in those programs that lead to the bottom line. Kimberly, isn't that really, if you look at recognition incentive programs, most of them are almost a given. A company decides, like I think it was Jim or maybe Glenn said that, well, we have to do these things. We're not really measuring, but we're a nice company. We want to be nice. So yeah, put a ping pong table in the lunchroom, or so let's have a Monday get together, a pizza party. But Kimberly, there really are tools like the master measurement model and the ROI of engagement processes. Companies really can measure these things, can't they?
Yeah, they can. And what decisions you make is a big part of the culture you have, and your strategic plan and your mission and your purpose as an organization. So while the ping pong in the break room might work really well for the startup, it might do little to advance overall engagement for a large multinational global, conglomerate. So I think you have to be very, as everyone on this panel has shared, you have to be very strategic. You have to invest your dollars wisely. You have to have a steward's mindset around those dollars to make sure that they are invested thoughtfully and intentionally. And a lot of companies, the average spend on a lot of those programs is running, in the thousands of dollars per employee per year. It's now gotten to 1% to 3% of payroll, and a lot of that investment can be retargeted more strategically and with a clearer line of sight to return on investment in line. And it should be aligned with your overall culture.
Yeah, Kimberly, you said something I just want to piggyback on, and the word was intentional. And the CEOs that I talk to who have done good things around corporate culture and have benefited in terms of increased sales, increased profitability, increased safety, reduced turnover, all the KPIs, there's a recurring theme in all those stories, and that is that they needed to demonstrate to their people that this was not a passing fad, that what they were doing was becoming sincere and intentional about creating a good environment. And it takes probably, in their terms, somewhere between 18 to 24 months before people realize that, oh yeah, I guess they're serious about this sort of thing. And it becomes embedded in the DNA. And that's when you start to see some of the magic happen.
Jim and Glenn, I think one of the really, this concept seems so simple, but it really isn't. And I think it has some huge, huge obstacles. And while I think it's red hot right now, I mean, because of, we'll talk at the very end about this concept of stakeholder capitalism that you're all going to be hearing a lot more about, because I'll say the societal in crowd now is really debating it. Harvard Law School, there's a debate tomorrow sponsored by Stigler, School of Business, University of Chicago, between professors arguing the merits of stakeholder capitalism, even defining it. And stakeholder capitalism is this concept that you will do better as a company. You will perform better if you focus on addressing the needs of all your stakeholders and engaging them in achieving your organizational objectives. So, and it's not just your employees, it's also your supply chain. It's also your communities. And so the whole notion of stakeholder capitalism, it's not about just giving away money to Black Lives Matter, because that's the thing to do today. Is that strategic to what your organization's position is in the community? Does it align with it? Then yes. And for many companies, because of diversity, it does. So getting to the next, I'm sorry, my questions come with introductions, because this is such a new area, right? So to ask you questions about things without explaining them is kind of difficult. So the notion of stakeholder capitalism is that you're going to do better by addressing the needs of all stakeholders. But Glenn, most companies aren't run that way. The CEO hasn't learned about this, right? He or she at your company has never heard of do you think she's heard of human capital ROI, human capital, or human capital value add, or this notion of developing a dashboard and then subjecting everything that you do to people to an ROI analysis? Sounds easy, but it isn't, is it?
No, and I think that, right now, to answer that first question, no, I don't think that our CEO has heard of that. I think that it presented in the right way, he'd be receptive to that. I think, again, there's only so many resources and money that can be spent. It's not a blank check. It's maybe redeploying resources from other areas, because by going through the analysis, you can find where money's being spent that doesn't need to be spent. So I think that, that's something that's easier to understand. When you get to stakeholder capitalism, it's interesting. I'd heard of it a few months ago because I read a book on Agile. It sort of talks about that from a different, methodology. And, I think in the trenches, we're probably still a little bit further away from that in terms of really not only being an agile enterprise, but in terms of therefore really embracing stakeholder capitalism. But I think it's coming.
Jim, what's your perspective on that?
Well, I think there's definitely an awareness of it and a great appreciation for the people side of the business, because that's all we really do. I mean, that is 90% of our cost. And, again, caregiver experience is critical to ensure a good patient experience, and the employees, really need to come first in that regard. I think the issue more is, not so much lacking an appreciation for it. The issue is really just the lack of traditional metrics. The financial and operating metrics have been around, for decades, right, if not centuries in some ways. But, this is all very new, and it's almost seen as separate. Like, okay, yeah, we have hard metrics for finance and operations, but human capital, that's all the intangibles, right? So, can we put, and again, that's not to say it's not important. It's just, can you measure it? And these metrics are so new. And another, issue is systems, right? I mean, systems, ERP systems have been built over decades around operating and accounting information, not so much the types of metrics that we're talking about. So I think it'll take some time for measurement systems and processes to catch up to where I think we all do want to be, and to the types of things we're all thinking of. I think it's just a matter of the process, the more tangible side catching up to the intangible.
Kimberly, This is amazing. By the way, what both of you just said sounds easy, but ordinarily that's a 10-year process. And I have enough gray hair to be able to say that. That is huge. Look how long it took for customer relationship management to take off, right? Mm-hmm. It took 10 years. And I still say customer relationship management is in its infancy. Anyone who thinks that's a mature business, most companies still are not using it to its full effectiveness. But Kimberly, there are many people,
even when you look at ERP systems in general, right? The big thing there was, okay, now we used to have financial systems and operating systems. Now we're going to integrate the two. Well, now we're going to bring the human capital side into that, right? So, that could take as long as it took to get ERP systems to where they are today.
Well, here's the good news. That's not the case in terms of technology. We could get off the phone and I could share with you 5 measures that you could calculate and know tomorrow. And you could take them right off of your P&L. Easy. All of the numbers that Dave and I know and have talked about are all readily available. Here's the real problem. What to do with it? What to do with that information? How to use that to drive decisions. So Kimberly, watching the clock here, I wanted to get into some brass tacks because the big challenge for companies like Jim and Glen's or any type of company is what to do. So the scorecards are easy to develop, right? We can develop a human capital scorecard within about an hour or two. And they're calculations you can do on your smartphone, no joke. But Kimberly, the process of developing a strategic and systematic approach, how would you suggest a company get started with this? Let's say a company decides, really, I've got 50% of my money going to my of my costs every year going to my employees. So, okay, now I've established my benchmarks. I've set up my human capital, metrics. Now what? Kimberly, how do I test improving those numbers?
Wow, that's a big question, Bruce.
Well, I'll help you if you have trouble.
Whenever we start talking to CFOs or people leaders around the topic of measurement, we always urge and counsel starting rather simply, starting with some basic metrics, measuring those, looking at what that tells us about the business, and looking at a targeted approach of a couple of things to address. And sometimes it just comes down to that one big thing that you want to focus on. There's a lot of tendency when people start looking at scorecards to say, oh, these 10 things should be better like tomorrow, and we need to, tackle all of them at once. And sometimes focusing in on that one thing that can make the biggest difference, organizations, it's all about, and this speaks to both of, Glenn and Jim, you as CFOs, you have limited resources and you have to apply those in a way that will get you the biggest return for the dollar. So sometimes it just comes down to selecting that one thing that we want to lean in on, that we want to spend the next 6 months improving, moving the needle on that targeted metric, and then look at the effects of measuring it again. Have we been able to, where has that measurement impacted the rest of the scorecard? So be pragmatic, be strategic, be intentional, but also be focused.
Well, that's great advice. And by the way, if anybody, we're going to wrap up right on time. So if anybody has any questions, use the chat. It's the easiest. Or anybody wants, like Darcy, to make some good observations. Because at the end of the day, and this gets back to what Glenn, you said, invariably, when you start using a dashboard, you'll save money. Because I can almost guarantee you that the things you're doing now are a waste of money, probably. But if you just blow them up and eliminate them, that's going to send a terrible message too. So it really starts with being strategic, whatever you do. And so when you develop those metrics, you can start with a particular facility. You can start with a challenge. We've had a safety challenge here. We're spending on this recognition program. What is it doing? Is it really helping us retain anybody? So I think it's fair to say that this approach can actually save money, but that it really starts, Kim, wouldn't you say, with a a gap analysis, identifying where there's a problem. Like Jim and Glenn, and you don't necessarily have to say but I would bet you, if you think of the couple of problems or challenges you have in your company right now, what percentage of them involve people?
Well, I mean, it's hard to put a number on it, but it's certainly a good portion. I mean, there's a war for talent out there, right? There's a shortage of workers, and there's definitely pressure to recruit and retain.
And Glenn, you have a smaller company, but I would imagine it's the same with you.
Yeah, I mean, you always have challenges with suppliers and customers. Sometimes you could argue, well, they're people too, but if I put that to the side, yeah, they are the last time I checked. But I think that when you take a look within our organization, we have our meetings, well over half are clearly people related. Maybe it's 80%.
And yet, think about it, gentlemen. How much training did you receive? Both of you are CPAs, I would imagine.
Yes.
Okay, so that requires advanced training. How much training did you get in human capital metrics and management in college?
None.
Took a class in basic human resources, but certainly not in metrics at all. So I guess you'd say no.
So human resources at most companies is really social work or compliance. It's social work, and it's not generally aligned with the business objectives. Am I wrong based on your years of experience?
I think it varies from organization to organization. I think, in some cases it may be like that. And in others, it's a business discipline. I mean, as financial people, we didn't get much training back in college, but, over your career, you become more and more involved. And certainly the HR professionals have that training. So I think it varies from business to business.
Well, I'm talking about the actual issue of translating this into, HR becomes a driving part of your organizational purpose, becomes a pivotal part of or a critical part of your financial plan, because productivity and quality, and Glenn, really important that you brought this up. Customers are part of human capital too. One of the very big challenges is that the human capital space gets siloed between HR and marketing. But there's great companies. Dave Ulrich, who's one of the great HR, I don't know whether Dave Ulrich has ever been a HR person, but he's a professor of HR, well-known, large following, but he's pissed off so many people in HR because he's always talking about connecting your employees to the customer. So Glenn, did you say you have employees that go out to people's homes as part of their jobs in any case? Do your employees have a connection with customers?
Certainly not to their homes. We because we're installing equipment at customers' work sites. No, we have a number of employees, not just salespeople, but you could say service technicians, because we're selling complex pieces of equipment, not only for installation, but also for routine service and, God forbid, there's a breakdown. So they are on site to some extent. The company is known by the tech because that's the person that you see. That's the face.
Well, the point I wanted to make there, and this is what's so critical, I was once involved with a company that got bought by IBM, but they were also a service technical business. And what they decided to do was focus totally on their service technicians as brand ambassadors. So in addition to giving them extensive training in obviously repair, and this was before the internet, okay? But this is the culture of the company. The CEO was really a people person, and he believed that everybody in the company should be a salesperson. And so it's the only company I ever saw do this. They turned their technicians, so their technicians got all sorts of sales training, cross-selling, and they came in and not only fixed stuff, but would engage with the customer and created lots of leads opportunities. And they actually turned their technicians into a profit center. And they held an annual incentive trip where they rewarded all their top salespeople. And who was there? Not only the top salespeople, but a bunch of the service technicians with their spouses getting these awards because they had done so much cross-selling. Because everything is about trust. And the service technician, and I have to tell you, I have rarely experienced, I don't know whether any of you have, a sales technician that really use that face-to-face opportunity to advance the brand. I mean, so when you start looking at business from this type of manner, every employee becomes a profit center. Every employee actually can add value. So, and the really big problem, and we're going to talk now a little about it to end with this philosophical thing, and then I'm going to sum up some of the key findings for those of all of you who have stuck through, but anyone who watches in the future as well. There's some really good findings that have come out of this. But the concept of stakeholder capitalism is that you make more money because everybody has the same expectation from the company: the customer, the employee, the supply chain. And they're great companies. Wegmans, if you have a Wegmans grocery store in your area, Southwest Airlines, JetBlue, these are companies that are run that way. Amazon, Microsoft, and these companies are very profitable, okay? And some of you may be aware of the ESG funds that are doing so, the environmental social governance investment funds that are doing so well. So here's the notion of stakeholder capitalism. If everybody buys into your brand, then there will be greater loyalty, willingness to refer, lower marketing costs, less turnover, less lawsuits, higher human capital ROI, greater EBITDA. So Dave, you wrote the book on ROI of individuals. What is standing in the way of this? Really isn't any harder than implementing ERP. In fact, I think it might even be easier because we already have ways to do it. Why? What is standing in the way of this sensible way of business taking over? And why would it have taken 10 years without COVID?
Man, great questions. I wish I had a great answer for you. All I can tell you is that, yeah, for sure, with COVID, it's never been more apparent that people really are an organization's most valuable asset. So if we don't get it now, I don't know that we ever will. But we are starting to see this momentum, and it is starting to become more of a hot topic. I think part of the challenge is this definition of stakeholder capitalism, and you've posted about it and spoken about it often, and the confusion has led to a political debate, and I think that people maybe get stuck in the weeds of how it's defined. But when I think about it, it makes perfect sense because I've seen in-house and working as a consultant and advisor for companies where they've gone wrong by making decisions on a short-term basis to satisfy shareholders. And if you're only looking at it on a quarter-to-quarter basis or just thinking short-term, near-term, you really don't have the ability to be strategic. And from what I've seen personally, it doesn't end well.
And you know, the interesting thing on this debate about stakeholder capitalism, the people on the left claim that it's just a buzzword like conservative, like compassionate conservatism for capitalists to rip off people under the cover of something virtuous. And then the right wing thinks it's a matter of taking money from shareholders and putting it in the pocket of stakeholders. But Glenn and Jim, from the standpoint of financial professionals, you're not involved with politics or running a business. Forget about that debate. It's bottom line. Is there a certain logic to you that if your stakeholders are aligned with the organization's purpose and brand, and their employees are continually focused on how they can satisfy that customer, and they're equipped to do so, that can have an economic benefit? Do you think we're moving out of the warm and fuzzy on this?
Yeah, I think it's so obvious. I mean, it's always been. I've always felt that you build a great company and the profits will come. And what does it mean to build a great company? It means you take care of your employees because they'll take care of their customers or clients. It means that you'll take care of the community. What's the whole value of a brand, right? A brand occupies a space in a customer's mind, and it evokes certain images, right? So that's, the customer has no clue how profitable you are, right? The meaning of the brand to them is so much broader, right? It's the culture, how you interact with the community, how you treat your customers, your employees. So, I think it's pretty obvious that building a great company, encompasses all of these things, and then the profits will come almost as a byproduct.
And
Glenn, I wanted to ask you, and Kim, I'm going to actually let you have the last word on this, so just bear with me 1 second. Glenn, one of the things I laugh about, because our organization is 100% nonpartisan, and I think anything in this country that gets politicized, unfortunately, gets beaten up. And so the only thing I'm happy about the politicization of this subject is at least now people are talking about it. I mean, that's important. Major professors, universities, it's going to be taught in schools now. That's exciting. But Glenn, one of the opponents to stakeholders capital, a top lawyer at Harvard, says that stakeholder capitalism, and I want to get your opinion on this, it doesn't work because it forces the CEO to balance the interests of all stakeholders. And I have to laugh because I've been a CEO. Now I don't have a bunch of employees, but at one point I had 26 and not that many. But I was always balancing interests of multiple stakeholders. And so to me, am I wrong? Aren't CEOs today, in a sense, balancing interests, and that maybe if we aligned interests, we would be doing a better job? What's your view on that?
I agree. I mean, I've worked in privately held businesses most of my career since near the beginning of it. And I've worked for a couple of very successful CEOs, and all of them balance that, because it's always a question of, you don't look quarter to quarter, to David's point. So I think that when you view stakeholder capitalism, it's kind of a natural. You're taking the long view, but also being privately held and not the largest company in the world, we always have to balance the needs of our customers, our suppliers, our employees. And if we don't get that balance right, we're not going to be in business for the long haul. So I think long-term profitable growth requires you to balance those needs. You can't just, ram it down the throat of your partners.
And I think if you can align their needs, that's where the magic comes in.
Yes.
And that's where that word purpose comes in. So Kimberly, you guys, your Protiviti is a major management consulting company. It's my understanding that you folks are actually really focusing on this whole human capital metric space. Why?
Great questions. The roots of Protiviti is as a risk management, compliance, consultancy, financial audit. So why the people side? And that's because when you look at large projects that have incredible operational value to an organization, there's always a people component and a people dimension that is going to make or break the success of the investments in those initiatives. And so the brand of Protiviti gives us a lot of permission to help clients evolve, to understand the quantitative value of human capital, to help them measure it more strategically, more intentionally, be more deliberate about areas of focus and investment to help grow and evolve their business. So, it's a good decision by the firm to evolve a human capital practice out of the basis of, a focus on metrics, a focus on the evolving human capital disclosure requirements, and have that multi-dimension, multi-stakeholder perspective, inside the organization, directly to people, to help them. I mean, when you think about human capital metrics, and if you're managing them and communicating them deliberately and strategically, it's going to help you become an employer of choice. You're going to attract the best talent to your organization. You're going to be able to keep them. You're going to be able to retain them, and evolve some of your operational elements to become even more efficient from an innovation side. So it's exciting, and we're, about a year into it, and we're seeing a lot of growth and traction and receptivity from clients around that message.
Kimberly, wouldn't you argue that most companies, if they take a strategic and systematic approach to human capital management, they can actually save money on things that they do because they simply aren't strategic and measurable?
Absolutely. It's a matter of more intelligently redeployed capital. It's eliminating expenses that don't make sense. It's about redeploying them with an investment to those areas that make the biggest difference.
Well, their HR is filled with bright, shiny objects with no ROI. Well, anyway, folks, you've been very kind today. As I said, this has been recorded. We'll have it probably posted within 2 hours, and we'll be marketing this over the next year. as a training program for people to get the perspectives of experts like you. So thank you all, Dave Bookbinder, James Caruso, Glen Hartenbaum, and Kimberly Lanier. You can find all of them on LinkedIn. And again, you can find this at the YouTube Enterprise Engagement and Human Capital channel. Thanks, folks, and see you next time, September 25th. Bye-bye.
Thank you, Bruce. Bye.
Thank you. Bye.